Hello, my name's Joseph Graff. Before I get started with the video today, I want to tell you all that this video is just one part of a 500-part series where I analyze the 500 largest companies in America. If you enjoyed today's video, I'll include some links in the description below so you can check out my other stock analysis videos. Also, if you enjoyed today's video, please hit the like button, please subscribe to the channel, and please hit the notification bell so you can be notified when I post future updates. This helps the channel to grow. With that being said, I want to thank you all for watching, and here's the video. Adobe was founded in 1982 in California. Adobe specializes in software and cloud services. Some of their most notable products and services include Adobe Acrobat, which is a PDF reader, as well as Photoshop. Adobe's operating segments include digital media, digital experience, and publishing. Adobe's largest operating segment in 2019 was its digital media segment, which was responsible for $7.2 billion of the company's revenue in that year. Adobe's fastest growing segment in 2019 was their digital experience segment, which had a 37% increase in revenue from 2018. Adobe is currently the 20th largest company in America and is valued at $212 billion. In this next slide, I'm going to show you all the company's earnings per share and earnings growth over the last 5 years. In general, good companies are able to produce positive earnings year in and year out and grow those earnings steadily over time. Large, stable companies such as Coca-Cola tend to produce positive earnings, but they might grow those earnings a little bit slower than a company like Tesla, which may produce negative earnings per share some years, but is generally viewed as having higher growth potential than a stock like Coca-Cola. In general, stocks that post positive earnings year in and year out, like Coca-Cola, tend to be considered less risky investments as compared to stocks like Tesla that may post negative earnings per share some years. In 2014, Adobe stock earned 53 cents per share. In 2015, this jumped up 134% to $1.24 per share. In 2016, they earned $2.32 per share, which was an 87% increase from 2015. In 2017, they earned $3.38 per share, which was a growth of 46%. In 2018, they earned $5.20 per share, which was a 54% increase from the previous year. And in 2019, they earned $6 per share, which was a 15% growth from the previous year. Overall, Adobe's earnings growth are some of the most consistent and high growing that I have seen out of all the companies that I have analyzed. Now that we've taken a look at the company's earnings per share over the past 5 years, we're going to talk a little bit about its price to earnings ratio, also known as PE ratio. PE ratio is simply calculated by taking a company's price per share and dividing it by the company's earnings per share. If you were trying to decide between buying shares in two different companies and everything else was the same, you'd want to buy the company that had the lower price to earnings ratio. This would be because you would be paying less for a company that is earning more per share. In general, companies that have a PE ratio below 20 are considered to be value stocks, while companies with a PE ratio above 20 tend to be growth stocks. In general, stocks with lower PE ratios are companies that investors tend to be a bit more pessimistic about the company's future, whereas stocks with higher PE ratios are companies that investors are a bit more optimistic about the company's future. PE ratio is just one small metric in the tons and tons of metrics that you can use to evaluate companies, but it goes a long way in helping you to get a baseline feel for why the company is valued at what it's valued at. On July 9th of 2020, Adobe stock was trading at $460.84 per share. This represents a 12-month price-to-earnings ratio of 60.8. This is significantly higher than the 12-month trailing price-to-earnings ratio of the Standard & Poor's 500 at the time of this recording, which was 22.4. As I mentioned earlier, a company's price-to-earnings ratio is just one metric that you can use to value the company. Another popular metric is a company's price-to-earnings growth ratio. This is calculated by taking a company's price-to-earnings ratio and dividing it by the company's growth rate as a percentage. In general, companies with a price to earnings growth ratio of 1 are considered to be fairly valued. Companies with a price to earnings growth ratio above 1 tend to be considered overvalued, and companies with a PEG ratio below 1 tend to be considered as undervalued. Price to earnings growth ratio is a popular metric among investors because it takes both a company's price to earnings ratio and its earnings growth into account. These two metrics are the two main metrics that drive a company's stock price and thus its valuation. As of July 9th of 2020, Adobe stock was trading at $460.84 per share. This represents a trailing 12-month price to earnings growth ratio of 3.06. This metric indicates that Adobe may be overvalued if this is the only value that you use to evaluate the stock. In this next slide, we're going to be going over the company's dividend yield, dividend growth rate, and dividend payout ratio. Dividends are popular among many investors because it's a way for investors to see a return on their investment in the form of cash payments. However, keep in mind that when companies decide to pay dividends to investors, that money that is returned to the investors is money that the company cannot use to reinvest into its own company. Dividend growth rate is the rate at which companies grow their dividends year after year. In general, investors like to see a high dividend growth rate as it means that they are receiving more and more money in dividend payments year after year. Dividend payout ratio is the percentage of a company's earnings that they pay out in the form of dividends. In general, companies with a dividend payout ratio below 70% have a good chance of being able to keep paying their dividend into the future and have some potential to grow that dividend in the future as well. Companies with a dividend payout ratio above 90% are generally seen as more risky and have a higher likelihood of cutting their dividend. Adobe currently does not pay a dividend as they choose to reinvest their earnings back into the company and try to grow it more and more. I could see Adobe potentially instituting a dividend in the future if their growth begins to slow and they start to see single-digit growth rates year over year. In this next slide, we'll look at two more metrics that you can use to value a company. The first that we'll look at is price-to-book ratio. You can calculate a company's book value by simply summing up all of its assets and subtracting its liabilities or debts. You can calculate a company's book value per share by taking its book value and dividing it by the number of outstanding shares. And then you can calculate the company's price-to-book ratio by taking its price per share and dividing that by its book value per share. Price-to-book ratio is a good way to get an idea of whether a company is overvalued or undervalued. A company's debt-to-equity ratio is calculated by summing up all of its debts and dividing that by the total shareholder equity. Debt-to-equity ratio is a good metric for finding out how much a company uses debt to grow their company. In general, companies with a lower debt-to-equity ratio will tend to do better during a recession. However, debt is a tool that companies can use to grow their company faster than they would if they did not have any debt. So debt is not necessarily a bad thing. Adobe's book value per share as of May of 2020 was $22.67. This represents a price-to-book ratio of 19.6. This is on the higher end of price-to-book ratios out of all the companies that I've analyzed so far, but isn't too terribly high, especially for a growth stock like Adobe. Adobe's debt-to-equity ratio as of June 2020 was 0.38. This is on the lower end of debt-to-equity ratios out of the companies I've analyzed so far, and I think it indicates that Adobe would do pretty well if there was to be a recession. In this next slide, we'll take a look at how the company's stock price has changed over the past 3 years, 5 years, and 10 years. Keep in mind that a company's past performance does not guarantee its future performance. However, seeing that a company has done well over the past couple years is usually a good sign and can indicate that the company may continue along that path in future years. If you had bought Adobe stock 3 years ago and held it for all 3 years, you would have seen an average annual return of 47%. If you had bought it 5 years ago and held it all 5 years, you would have seen an average annual return of 41%. And if you had bought it 10 years ago and held it all 10 years, you would have seen an average annual return of 32%. These are some fantastic gains over the past 3, 5, and 10 years, and these returns definitely beat the Standard & Poor's 500 over this same time period. In this next slide, I'm going to give you all my grades for this stock. The first grade that I will give you is what I grade this stock as a defensive investment. This grade is simply a grade that I give based on how well I think a company would do during a recession, as well as how confident I am that the company will continue to generate the same or greater earnings over the next couple years. The next grade that I will give is a growth grade. This grade indicates how I feel about the company's growth potential over the next 5 to 10 years. The third grade that I will give is the company's value at its current price. I'll take a look at what the company's price is at the time I recorded this video and give you all my opinion on whether I think it is undervalued or overvalued. The last grade that I will give you is an overall grade. This is a grade that looks at this company as a long-term investment. This grade indicates how comfortable I would be with holding this company for 10 to 20 years. As a defensive investment, I gave Adobe a A-. Adobe has a lot of software and cloud services that are more or less essential to businesses. I don't see why the need for their software will become any lesser in the future years, which is why I gave them an A-. As a growth investment, I gave Adobe a B+. I give them a pretty high grade here because they have grown pretty fast over the past 5 years, and I don't see any reason why they can't continue this in the future. As for Adobe's value at their current price, I gave them a B. Their PE ratio is pretty high, but their growth is pretty phenomenal over the past 5 years. As an overall investment, I gave Adobe a A-. I think this is definitely a company that if you buy it and hold it for a long time, you'll be pretty happy that you bought it.